So good morning. Welcome everyone to this session on VC financing rounds. So my name is Jacques Bonvin. I'm a partner with a law firm Niederer, Kraft, Frey. It's one of the largest Swiss law firms based in Zurich and Geneva. We are a tier one corporate law firm. And I personally do corporate work, M&A, private equity and venture capital, and I've been very active in the Swiss startup ecosystem for quite a while, advising startup, scale-ups, investors, and other players in this field. Besides, I've had a few in my life, what I call pet projects on the side, where I've advised, Solar Impulse, the solar-powered airplane of Bertrand Piccard and André Borschberg, on all the legal aspects. I've also advised a team that competed in 2 America's Cup, Artemis Racing, a Swedish team, and now I'm advising Climate Impulse, the new project of Bertrand Piccard of a hydrogen-powered plane. I'm also on the board of Fongit, the largest incubator in Switzerland, based in Geneva, where I try to contribute a bit to the startup ecosystem. So today the idea is to go a bit through do's and don'ts in a VC financing round, and maybe before I deep dive into it, who has already done a financing round? Okay, only a few. Who knows what, if I say drag along, you know what a drag along is? A few people. You know what how an anti-dilution works? You know why we call some shares preferred A, preferred B? Let's see. Okay, so I'll be very brief, but just on the context. If we see the numbers, now it's probably a bit better than last year's in terms of fundraising for startups. But it depends very much on the industry and the sector. You have some sectors, of course, like AI, like defense-related industries, where there is a lot of hype, lots of money going on, and you can do rounds fairly quickly. There are some other areas like biotech, life science generally, where it's probably more difficult. It's picking up a bit now, but a bit more difficult. So I would say we're still in challenging times. And I think it's important just to understand that these challenging times make things a bit more difficult, and there are different things to take into account. So I will also mention that a bit today. So the plan for this session is to, after a short introduction, is to go through the main challenges in challenging times, speak a bit about how do you prepare for a financing round, what are the key legal documents, and what do you have to do with it as a founder of a startup or as someone helping a startup, raising money. What are the main issues you will have to negotiate, and we will end up with some takeaways and some conclusions. Feel free to interrupt anytime. Feel free to ask questions. If it's too fast, too slow, tell me. I'm happy to adjust. I ask you a few questions to see a bit, the level, but of course you all have, different expenses, different background, and don't hesitate to ask questions. There is never a stupid question, only stupid answers. So in terms of, first of all, what is very important to understand is when you do a financing round, you enter into something that is a very unequal negotiation. Because most founders, they will do that for the first time, or maybe they've done a few rounds, but a few times. Maybe they even serial entrepreneurs, so they know a bit more. But at the end of the day, on the other hand, you will have investors who are doing that on a daily basis, who have their routine, who have their processes, who have all their standard form, their templates, their regular advisors, and so on. So it's never equal. And it's also a world where there is no mercy. Basically, the investors, most of the time, they will push hard, to get the better terms. They will tell you that's what the terms are, and so on. And so you have to resist. And what gives you a bit of weapons to resist is to base yourself on what are the market practices, what are the market standards. And that's something that you will learn in events like this one. You will also learn by talking to other startups. You will learn by talking to your advisors, lawyers, etc. Lawyers in the VC environment, They have a different breed. There are people who do that all the time, and you have to go to this lawyer, they do that all the time. They know the market, they know a bit how the investors are, they know what the practice is, so they will tell you, this is totally off market. This is not the way we do a deal like that in Switzerland versus the US, for instance. And that's very important because that's where you can put the limit. These limits, they vary. That's why I say, because of the context. So in challenging time, of course, the limits, they vary. They're more in favor of the investors. But maybe if you're in an industry where you know there is a lot of attraction, then they will vary the other way. It's also true that there are different processes and different terms for different startups. You will not handle the same way a seed round as a startup, where you will be a lot in the lead. In a seed round, a startup can be in the lead. A startup can be the driving force in producing the documents, in suggesting terms, etc. Which is at the time when you know less, but it's a time where actually you can influence more. When you do later stage rounds, you will have VCs who will come with very clear ideas, and they will come with strict position, and they will probably take the lead. They will say, we draft, all lawyers draft the documents, we take the lead. So this is different. And the same way, of course, depending on the industry, you have differences. What is important, and I'll speak a lot about that, is to have the right team, to really understand how the timing works, and the process, so you're not completely lost in the process and then impacted, because most of the time when you do a fundraising, you don't have a lot of cash available, so the time is against you, and it's very important to try to manage this time properly, and also then to say, what should I focus on? There are some terms where some startups, they keep on negotiating, and at the end of the day, it's not that relevant. So again, this is something where people who have experience can help you find your ways. When I speak about challenging times, what are the specific challenges you have today and you had last year and now? Is that, first of all, the valuation are lower, and there is a push to have lower valuation. There are some exceptions. As I said, AI is different. In AI, valuation are still high. People really want to find the right AI startup. That's a different story. Or recently, we advised a company in the space industry, raising a 40 million seed round. This is a huge amount for a seed round in Switzerland, and that's because now space is attractive. It's linked to defense. It's linked to sovereignty in Europe. So you have this special situation. But generally speaking, it's more difficult. You see also what we call down rounds. What do you know? What someone knows what a down round is?
Yeah, lower valuation than in the last round.
Exactly. And this is something now we see frequently, and it has an impact, because I'll come back to that later, but very often you have some provision in the contract that says if there is a down round, you will have to give some shares to the investors who invested previously, because they will say, it's not possible, I'm now in a company that has lost value, you need to compensate me for that. What we see also in these times is that the investors, they're more picky than they were before, and they will pick for certain sectors. They will look more into what the company is doing, and they will also look a bit more long term. What are your financial needs? Not just what the money you need now. Is when you raise money now, is how much money will you need, and in what sort of time frame? Because they will look at that, and they will have to assess whether it will be possible for you to reach the milestone you need to reach for the next financing round, and you will be able to raise the money. And if you're not able, how much they can put. So most of the investors today, they don't just put a certain amount at a given time. They also commit. I mean, they may not necessarily tell the startup, but they will commit internally to a certain amount that they can put later to make sure that the next financing round goes well and the company continues to grow and have the necessary cash to move. You can move to if you want to see it. There are still some seats. The other impact of this challenging time is on the timing. It takes more time. It takes more time to actually find the investors and get the investors to come with a term sheet. I'll tell you exactly what a term sheet is in 5 minutes, but to come and make an offer. Not necessarily once you have an offer, it can go fast. And I was talking to some startups last night and were saying, it took us a lot of time. We were almost, bankrupt. But then once we found the lead investor, it took only a few weeks to go through closing and to get the money on our bank account. So it's not necessarily the last part where you really negotiate the final terms, but it's finding the right investors before. Very often you also find investors what we called who are not lead investors. So they will be there, but they will say, we're not leading the round, we're not negotiating. We're happy to put some money, but someone else has to take the responsibility of the due diligence, of negotiating the contract, and of being the front runner in the investment. This means also that if there is more time, you need to find a way to keep financing afloat. So that's why you probably hear a lot about this convertible financing, etc., convertible loans. That's not just because investors say we want to do convertible. I mean, very often the convertible is not so much in favor of the investors, because when you do a convertible, you don't know exactly at what terms you will convert. But it's more that it's the way to get money in between. It's that you need to raise a bit of money to stay afloat, and that's why you have all this alternative financing in place. So on the this one. Yes. So of course, in this challenging time, you have a bit less of deal certainty. So meaning you're not sure until the end that you will close, and of course also you can have last minute renegotiation. So it's again a bit more difficult, and the terms, as I said before, much more investor friendly. So a bit on the preparation. Never underestimate all the preparation you have to do. And I think the preparation you need to do before financing, first of all, is to have your house in order. So make sure, and today with all the tools we have, it's easy to keep the document in a structured manner from day one. And you basically build your data room for day one. You will store your document electronically the way you can then make them accessible to third parties. And that's important to start from scratch, because this will give also an impression. The first thing that investors will ask the advisors, lawyers, financial advisors, IP advisors, what's your general feeling? Is this company well organized or not? And we know, when we do a due diligence of a startup, we know it's a startup. So we're not expecting that you will be organized like Novartis or Nestle. But we will see if the documents are generally well written, if you've done just the normal mistakes a startup will do, or if everything is a mess, and that you have no idea, no clue of how things work. Because that, of course, it doesn't mean you will not get the investment, but it may mean that the investor will know you will have to invest a lot in doing that, and he will have to also put in place something to correct this situation. And then we create electronic data rooms where we share documents with the investors. And of course, in these electronic data rooms, you can start sharing limited information, not highly confidential, and then throughout the process, share a bit more. It's also important to prepare all the investment material that's a given. And today, frankly, with AI, it's super easy to have nicely produced documents. It's easy to have the good start, but you have something that differentiates yourself, because with AI, everything is the same. So you have really to make sure that you have material where you can convey the right messages. Then you need to set together a team who is going to negotiate, because when you do a financing round, it takes a lot of bandwidth. So you will not have time to continue manage the company the same way. So you have to have a team with a combination of the founders, because you need the founders, or at least one. You need a founder who is really in the driving seat. together with an internal team of people who can help with some documents, help with liaising with the investors, etc. And besides, you will need some advisors. The advisors you will need, you need lawyers, and you need to involve the lawyers early. Don't involve the lawyers once you have signed the term sheet. It's too late. Involve them before. Take them as a sparring partner and then discuss. And if you don't know, even if after today you still don't know some of the terms, they will help you before. That's very important. You may need a bit of help of your accountants, etc. For some of the documents. That's what you need. You don't necessarily need people who are there to help you raise money. Most of the time, at this early stage, it's not a good idea. The investors, they want to deal directly with you. They don't want someone who takes a commission in between and who has no added value. So this is not. So you build the team, and then you make sure you have a cap table. You make sure that you have an Excel sheet that you produce yourself, or you ask Claude to produce. But you have your Excel sheet where you can already look at what will be the impact of the financing round, how will it work, what will be the dilution, and not only this one, what will be the dilution of the next one. What will happen, because you say next one, okay, we will raise the valuation by whatever, 50%, we will need to raise another 10 million. What is the impact? Already look at that, exactly what the investors will do. Do it yourself. And again, it's also a way of showing that you know what you talk about, and not waiting for the investors to actually have to produce the cap table for you. They will do it. If you don't have nothing, then investors will do it. I mean, of course, they do that on a regular basis. So that's for the preparation. Again, if there is any question, do not hesitate. After all that, and you will have your list, you will start looking at the investors, etc. The main point is, the term sheet. Is getting a term sheet. So what is a term sheet? And you can share. I've given you here two examples, a long one and a short one. You can also share that if people want to have a pen. So you will go to the term sheet, which is a document. It used to be like that. So a term sheet, it's based on the way banks were doing when they're doing bank financing. So basically, you have some titles and a short description of the terms of a financing. And that's an example. Of course, I created it, but based on real-life example. That's an example of what you will have in a term sheet. That's a bit of a long form. What we see a lot of these days, and you see for big investors, if you go with the very large European investors, Index Ventures, Sofinova, all these people you've heard about, they will come rather with something like that, one page. A one-page term sheet with the basic terms. What is this? This will give the intent. This will indicate the main terms of the financing. What is the valuation? What are the conditions around this? And what is the process? Do we have an exclusivity? Do we have a certain timing? That's what you will see in the term sheet. A term sheet. So it's a legal document, but it's generally, in most of the cases, it's non-binding. Meaning it's not because you sign a term sheet that the investor is forced to invest, and it's not because you sign a term sheet that you have to accept the investors. It's a conditional offer. The only thing it creates an obligation to negotiate in good faith. So you cannot sign a term sheet with certain terms. The investors start doing due diligence, investing money, and then you start completely changing the terms. If you do that, you have a risk that you will be liable for the costs that have been paid by the investor who say, but you change everything. We invested on this basis. Now we cannot invest. We spend money. That's what. But that being said, practically, it's like binding. You sign a term sheet like that with a serious investor, he will expect that you will follow this. And that's why I say, get people to advise you before you sign that. Even though it's a one-pager, it contains all the main terms. So based on that, the investors, or if you're drafting yourself, you give that to the lawyer and they will produce two main documents. An investment agreement. The investment agreement will describe the investment. It will say How much money do we invest? How do we increase the capital? What are the representation and warranties that are given for the investment? What is the time frame? And are there some conditions before we close? That's what you will put in the investment agreement. That's the first document, which will be signed by the existing shareholders, the company, and the new investors. That's one key document. Sometimes it's called share purchase agreement, sometimes it's called subscription agreement. In Switzerland, generally it's called investment agreement. But the second one is a shareholders agreement. The shareholders agreement, I mean, you probably all know what a shareholders agreement is, but the shareholders agreement will set the rules among the shareholders going forward. So once the investment is done, what are the rules governing the relationship between the existing shareholders, the founders, the investors, and I'll come to what the terms are. But this is the second document. So investment agreement, shareholders agreement. You will have that all the time. Then you may have some side agreements. Of course, very often you renegotiate the employment agreement of the founders or of the C-level. And you also very often have IP assignment agreement, because if IP has not really been put correctly into the company, every investor will want to make sure that everything that where it's not clear, we sign something to really put it in the company when the investment is made. If you are at a seed stage, or pre-seed or seed stage, what I would advise is that you prepare a term sheet. You prepare the term sheet with the terms that you want, and then you start talking to people. A lot of seed investors, they will be fine with your term sheet. It's true for family offices. It's true for very large business angels. Some business angels, they can invest tens of millions alone. It's also good for groups of business angels and small VCs. Most of the time, they will be fine if you come. They may negotiate some terms, but you come with that. At a later stage, you will probably start discussing with the investors a bit what the terms you want, and then you will expect to get a few term sheets. I mean, the objective is to have 2-3 term sheets on the table so you can then compare, you can then negotiate, improve, and very often, at some point, you have to make a decision, because the investors will tell you, we want exclusivity. You have to commit to one term sheet, give us exclusivity, and that's where they really start spending money outside. Before, they will do everything in-house. They will have their team looking at your company. They will do some initial due diligence, etc. But once there is a term sheet, then they will start, spending money with, I don't know, IP advisors, with an accounting firm if they want to look at certain things, with lawyers for sure, and that's when it starts. And then, of course, there are still some negotiation, because, from that to go to 60 or 70 pages of contract, of course, there are still something that you will negotiate. But the main terms are there. And once you've signed a term sheet, normally, if things go well, if you have, decent investors, there is no big surprise, you should go to the closing. I'm not saying there will not be some renegotiation of the terms, there will not be some changes. And that's also why people say when you get a term sheet from a very decent investor with a good reputation, a good VC, I mean, it's almost binding or practically binding, and also the investors, they have a reputation, so they really have to have a good reason not to invest, because otherwise everyone will say in the market, don't deal with this investor because, and there are some like that, because often they renegotiate everything, and you end up not having money invested. So that's about the term sheet. The risk with these small term sheets is that very often it says standard terms, standard reps and warranties, standard covenants, and of course that's often not ideal. If you have something like that, it's clear. If you have something like that, you can negotiate the various points. How do this provision apply, and you know a bit more at the beginning. So probably what is important, when I was saying at the beginning, focus about some key terms. Maybe some key terms you could say, I want to specify certain things. For instance, I want to make sure that And I'll tell you a bit more about that, that if there are some warranties that are given, the warranties are given by the company and not by the founders themselves personally on their own assets. Maybe that's something you want to specify. So that's typically, you can make some changes, some negotiation on a short term sheet, and I would recommend to do that if you have really key points to do that at this point in time. What do we have in this term sheet? What do we negotiate in the financing round? So we're going to negotiate the valuation, we're going to negotiate the terms of the investment, and we're going to negotiate the future. Future meaning the governance of the company, and meaning also exit, sale of shares, all these aspects. And that's what you will have again in the investment agreement and in the shareholders agreement. So valuation, everyone speaks about valuation, but valuation is only one element. Never forget that valuation is only one element, and that all the other aspects, they can have a huge influence on the future of the company, on the way it will operate in the future, on what can happen to their founders or not. So you should not focus only on the valuation. And by the way, for valuation, the objective is not necessarily to always get the higher valuation or the highest valuation. I mean, it's important, of course. A nice valuation means lower dilution, but the higher the valuation, the more pressure you have. And don't forget, the worst thing is to have a very high valuation, be unable to deliver on your promises, and then go to a down round, because that's really bad. It's bad on all fronts. It's bad because you will not like that. It's bad because investors will not be pleased. It's bad because it's of course a negative news in the market. It's a negative news internally, and even if you don't publish it, people know it. I mean, a small ecosystem, we know when a company does a down round, and there are lots of rumors. So it's bad. So pushing too high the valuation is not necessarily the game. And you have to see, but of course, if you see that there is a lot of appetite and you think you can deliver, etc. But that's very, very important. The same way, raising too little money is also not necessarily a good thing. Of course, a lot of the first approach is, let's not raise more because we're going to be diluted and the valuation now is low. But raising money is difficult. Don't forget what I said at the beginning. It's challenging in times. So it's not because you raise 5 million today that you will easily raise the 15 million in 18 months. So you have to find the right balance, but taking a bit of a buffer is not necessarily bad. Sometimes you're lucky and you can find a system where the buffer comes like a second tranche as a slightly higher valuation. Sometimes you don't have the choice. You take just a bit more money, a bit more dilution, but you know that you have a bit more time to reach your milestone, and you have this buffer that everyone knows. Because I've seen hundreds of startups. What I've seen in common for all the startups is first, it takes always longer than expected. It takes always more money than expected. And there is always a point where you're on the verge of crashing. Always. No exception. No exception, but that's true. That's true for everyone. That's true for Facebook. They also were on the, even if then they found a solution, then they did, large financing round, but it's true for all the companies, SpaceX, all of them. So even the biggest success we have. So that, again, on the valuation, do you know, can someone tell me what pre-money valuation is, post-money? Do you know this concept? Correct. And if I have the concept fully diluted, what is fully diluted? Yes. So I will just repeat. So pre-money valuation is the valuation you have before the investors invest. So you said today our company is valued 10 million. And then you can calculate the price per share, because you get 10 million, you divide by the number of shares, it gives you the price, the valuation per share. then if you raise 5 million, the post-money will be 10 plus 5, 15. The post-money valuation will be 15 million. And the concept of fully diluted, which is very important, is how do you calculate? When you have the 10 million, do you divide the 10 million by the number of shares, as I said before, that's non-diluted? Or do you take into account options, that you have granted option to employees, that potentially, you will have more shares? Do you take into account convertible loans? Do you take into account other instruments? And now, in 95% of the cases, somewhere in your term sheet, it will say fully diluted. So you really have then to calculate. And you may negotiate a bit, because you may say, yes, we have an option pool of 10%, but today we've given 2%. So don't take that. Let's take into, for the valuation, take only the 2%, because the rest is just virtual. We have not even granted that to anyone. And of course, you can give options that people may leave the company and they may never exercise. So fully diluted is already in favor of the investor rather than the company. But it's quite normal to have fully diluted. I mean, at the end, it's a negotiation on the number, because if the number is higher, then but what is important is to be clear from day one. The risk is that you agree on a number, not understanding it's fully diluted, and then you cannot go back. When you say 10 million fully diluted, you don't understand what it is. You cannot say, oh no, let's do 12 because we have 10% dilution. So try to be clear as to what people are talking about. Then, linked to the investment is the question of milestone tranches. So more and more the investors will say we invest in tranches. Yes, we sign a contract now, but we will give you the money in different installments. And very often, there are milestones. They will say, yes, we'll give you the money once you have done X, Y, Z. Sign your first contract, hire a new CSO, file the IP, all these things. If you can avoid. So if you can get everything at once, it's okay. If you can get everything unconditional stuff, just that, maybe the money doesn't come at once because people don't want to give you 10 million on a bank account on day one because they think, let's give you 5 and then we give you in 6 months 5, just that's probably okay. And if you have to accept a tranching, then make sure that the conditions, they're objective and that it's not something that it's clear. That's what we have to do. Filing a first patent, okay, that's very clear. We know what it is. Or filing the patent for this product is clear. If you start having ambiguous thing, you can have long discussion, and of course, you're not the one sitting on the money. So at the end of the day, the investors can push or delay, etc. And okay. So classes of shares. So someone told me before, what A shares, B shares are. Can you explain? When you start the company, you have ordinary shares or common shares. Huh? What is A shares, B shares?
So for each financing round, there are new classes of shares created, and they have normally the first one in is the last one out. So the preference goes down from the latest to the first.
I think it's more that it can be also that there are Class A shares that are again Class A share for the second financing right, for example. But in the end, it's more that the common shares are standard shares, and the preferred shares have different voting rights attached, or different rights that are given to the investor.
Yeah, so it's right. If different classes of shares, they are linked, of course, to rounds, and they are linked to some preferences of privileges that you give to the shares. Not so much on the voting. Most of the time is one share, one vote. But it's more on the dividend, and it's more as what you were hinting at, the liquidation preference. I'll come back to. So who gets paid first? And they basically called A, B, C, D, like the round. And that's why you have now also, in Switzerland, we use a lot, we have pre-seed pre-seed shares or seed shares, and then preferred A, preferred B, exactly to name after the round. You could name whatever. I mean, I've had some clients who decided to go with a totally funny name. That's okay, but then you just have to describe in the articles of association what the preferences are and in the shareholders agreement. Early stages, if you do pre-seed, etc., if you can keep still common shares for everyone, it's very often easy because it makes things easier later. Everything is easier if you keep it simple at the beginning. Simple, limited rights to early stage investors, limited rights to business angels, etc. Because people find it very hard to give away things that they have obtained, and it creates problem in future rounds. And VCs, they don't like huge cap tables with many investors, and they don't like cap tables with investors who have plenty of preferred rights, because then they have to negotiate and say, this is all gone. We remove everything. Now we give the rights to the people coming with the real money. So if you can limit early on, it's better to limit, including keeping common shares, not going with this pre-seed, etc. It's not a disaster if you do so, but it simplifies things. So I've put the terms a bit in the order of importance, so then that's why now I'm talking about exit. Exit is, of course, a very important thing, because an investor will invest in a startup or in a scale-up with a goal to exit after a certain point in time, be it via IPO or be it via a trade sale. That's clear. So it's something that is on the table. And in terms of exit, there are certain things that you will address. First, you mentioned the liquidation preference. So what is a liquidation preference? Is to say that at exit, you will first give the money to people who have the preference. And most of the time, this preference is linked to the investment. And you may have heard about 1x liquidation preference. 1x liquidation preference means that if you sell the company for 20 million and you have an investor who has invested 5 million, the first 5 million, they go to the investor. And then the rest, that will depend. That's depend on what you negotiate. If you have what we call participating liquidation preference, which is the most aggressive, the most favorable to the investors, then the 5 million, they go to the investors. The 15, they split according to the shareholding in the company, meaning the investors will get a bigger share. So with a liquidation preference, even if the investors, he has 20% of the company, he may end up getting 30% of the money. That's what it means. If you have something which is called non-participating, which is more common in Switzerland these days, non-participating means the investors will get in priority only if it's more than what he would get splitting simply by shareholding. So if you split and he gets his 20%, it's more than the 5 million, he would just get the 20%. So in Switzerland, what you would try to get is a 1x liquidation preference, non-participating. Sometimes investors, they will say it's 1x plus an interest. So meaning every year, the amount increases. In the US, they do 3x. In the US, you get plenty of money, but also there are plenty of investors who say, I want to be first, get 3x. And this, of course, has an impact if you sell at a low valuation. If you sell billions, it will be completely insignificant at the end of the day. But of course, when you sell at a low valuation, you may end up, and there's been situations like that in Switzerland where your founders, they got almost no money. Everything went to the investors, and there are examples like that. So that's the concept of the liquidation preference. Important. Then, right of first refusal, tag along, drag along. Who knows this concept? You will have that in every single shareholders agreement. Every single agreement will have right of first refusal, tag along, drag along.
sell, it's to give the right to the minority also to sell your shares also for the same valuation.
Clear for everyone? So, tag along is a minority protection. Tag along means if there is a certain percentage of the company that is sold, you can sell at the same condition at the same time. So this avoids the situation where people sell 80% of the company and you have 3% and no one wants you 3%. And someone buys 80% of the company and says, with 80%, I can do whatever I want. So the tag along is for minority shareholders to say, I can sell at the same time. Most of the time, the tag along applies when there is a change of control, meaning when there is more than 50% that is sold. Sometimes it's also pro rata, in saying whenever there is a sale, everyone can sell the same pro rata. So if someone sells 20% of the company or 20%, everyone can sell the same proportion. Drag along is, as you said correctly, it's the opposite. Drag along is to force someone to come. So that's to protect the majority investors, to avoid that someone with minority stake will say, I don't sell, and then you don't have a buyer because most buyers, they want 100%. And the drag along, usually the threshold is higher than just the 50%. Usually we're talking 60%, 2/3, 70%, 80%. Or sometimes you say the drag along, it's the lead investors plus at least one founder. So because there you can force people to sell at the same terms. The right of first refusal, that's just to protect existing shareholders versus new one. If someone wants to sell some shares to a third party, he first has to offer to the existing shareholder. And that you have most of the time in favor of everyone. Sometimes the investors, they want a priority, so it's first for them, and etc. It's just a way also to keep people with their shares and say we all exit together. Because when you have a right of first refusal, it makes things difficult to go and sell. And if there is a good reason, you will find a way because you will ask all the investors and say, yes, I want to sell, I don't know, to some relatives, etc. You find a way. Either the contract says there are some exceptions, you can sell to your family members, or you can sell to a related company. Or if there is no exception, usually it takes a bit of time, but you will get the other shareholders to accept because they say it doesn't change anything. I have a good reason to change. So that's the right of first refusal. Then you usually also have some provisions about the IPO, but unlike the US, in Switzerland and generally in Europe, it's difficult to have really binding provisions on IPO. In the US, you can have actually provisions where an investor can force an IPO. In Switzerland, you have more, general principle that everyone agrees, and you will agree to do certain things if there is an IPO, and that at least a small group can push the others, and you cannot block an IPO. Usually, it's not really a problem, and people are, of course, everyone is happy if there is an IPO, and it seems to be the right way out. Beside the exit, so there will be some rules on share transfers in a company. So beside the right of first refusal I mentioned, there is also a very important point is preemptive rights. So preemptive rights is what happens if there is a new financing round. Can you subscribe for shares? The rule in Switzerland is by law you have the right to maintain your share in the company. So if you have 10% of the company, if there is a capital increase, in principle, you can subscribe for the 10%, which is not the case in other countries. I mean, I was talking before about Facebook. That's exactly what happened to in the US to Severin, who was one of the founder of Facebook. Is that they did a capital increase, he could not participate, and he was completely diluted because he had no preemptive rights. But in Switzerland, generally you have. It may be theoretical because you may not have the money to be able to reinvest, but generally you have that. Sometimes there are some exceptions. If we do a capital increase to acquire a company or to do a capital increase to raise some money. Lockup. Very often you will be blocked from selling for a certain point in time as founders and sometimes all the existing shareholders. So it's quite common to have like a 3 years or 5 years lockup and saying Now we're all together, so no one should go and try to find a market for his shares. You cannot sell. Frankly, not really a problem. I mean, normally, you will want to exit with the other if you're a founder. The lockup, it's not something I would really fight. What is more important is the call option, put option, good liver, bad liver. I think you've all heard about that. You may have heard about that in terms of option plans, etc. But what you need to know is that as a founder, even if you've had your shares for a while in the company, you own the shares, you've paid for them. Since no option, they are shares. When you have a round of financing, the investors, they will want you to have a situation where you may have to sell your shares if you're a bad liver, because they will say, we invest to the company now, your company has 5 years, we know you have your shares, but if you leave in the next 3 years, we can take your shares back. Because we're investing on you and you should not be leaving. If we have to fire you because you do something bad, we can get your shares. If you die, if you're becoming capable, so very often you have this good liver, bad liver provision, which are, that's a difficult point to negotiate, because you, as a founder, often you negotiate that with your employees, but it's more difficult for you to say, I'm already in this company and you're telling me that, if you fire me, you can buy my shares or 50% of my shares. Very often, it's on a scaling model over time, and it reduces the same similar way as a reverse vesting or vesting mechanism. But that's often something tough to negotiate. The other thing you negotiate in a round is what happened with future financing. I mentioned before this anti-dilution. Most people believe still in startup that anti-dilution is to protect you against the dilution. No, anti-dilution is to protect an investor against a down round, a round at a lower valuation. And usually the mechanism is that we will calculate if he had invested at the lower valuation, how many shares he would have had. So let's say he has received 1,000 shares. If the valuation was lower, he would have received 1,500 shares. He will get these 500 shares for free. I mean, there are some mechanism. I will not enter into the detail, but at the end, that's what happens. That's what anti-dilution happens. It's inevitable. So you cannot really say, I don't want this anti-dilution. It's inevitable. You can try to find some boundaries, to negotiate a bit. At the end of the day, you probably have also some protection because the new investor, usually they will not accept that the anti-dilution is applied fully, because the consequence is at the end of the day, the founders are diluted. So if I come later, even though it's a down round, I don't want that all the dilution goes to the founder, and then they're really not pleased anymore. So it may end up in a bit of a tension or fight between the new investors and the existing investors who are benefiting from the clause, and saying, no, don't take all of it, otherwise we don't invest. We're okay that you get a bit of free shares, okay, you compensated, but not all of it. And but there are ways to negotiate things, like, for instance, the anti-dilution applies only if the investors put more money, or it applies only below or above certain thresholds. But it's in this current environment, it's important to see that. So these were all the financial terms, so that you will find basically in the shareholders' agreement. And coming back to the shareholders' agreement has 3 main parts. One part is the governance, which I will just discuss now. How is the company managed? Another one is all these things about transfer of shares, exits, and so on. And the last part is some obligations like confidentiality, non-compete. That's the last part. So 3 parts in the shareholders' agreement. So the second part is about governance. So in a Swiss Aktiengesellschaft, Société Anonyme, what is the majority to make a decision on normal stuff? Do you know? At the shareholders level, you do a general meeting of the shareholders. How do you decide? Majority of all the shares, majority of people who come to the meeting, majority of... and different views.
Have a quorum.
So by law, there is no quorum. So there is meaning that you don't need to have a minimum of shares that come to the meeting. So in theory, in Switzerland, you could have one person with one share coming to a meeting, is alone, and then you can decide. Of course, it's theoretical, but that can. So yes, normal rule is simple majority. So 50% plus one vote of people who are there. And there are certain decisions, some important decisions where you have a rule of 2/3 majority. If you want to change the purpose because of the company, change the seat, do certain type of capital increase, create a conditional capital, create a capital band, which you use for option plan, for convertibles, etc., or to give power to the board to increase the capital. So certain things there is special majority. And at the board level, what is this? How does it work? Majority of the directors present, quorum, no quorum. Yeah, most of the time, you could change that, but most of the time the quorum is the majority of the directors. So you have 5 directors, 3 needs to be at the meeting, and then simple majority. So if there are 3 and 2 out of 3, and sometimes you have a casting vote for the chairman, which is by law you have a casting vote. You can change that, but if you don't do anything, you don't say anything in the article, there is a casting vote of the chairman. So what you understand is that when if an investor invests maybe 10 million in a company for 15% and 0 or 1 bond seat, basically he has no say. You can overrule him everywhere. So of course that's not acceptable for the investors. And that's why, investors will ask for what we call, in the legal jargon, protective provisions. They will be protected, and these protective provisions, they can take different forms. One form is to have special majority. To say certain decision, it's not 50%, 63 2/3, it's 66 2/3, it's whatever, 90%, so different majority. Or, more common, a veto right. Certain decision, you need to have the agreement of the investors, or a majority of the investors, or the board member representing the investor. So that's very common. And if you look, in Switzerland, give me the opportunity to mention that, there are SECA, the Swiss Venture Capital Association, the Private Equity and Venture Capital Association. They have some templates of investment agreement and shareholders agreement, which are a bit heavy, but it gives you an idea, and you will see a typical list of the veto right. You also have a typical list in this term sheet. Typical list in saying protective provision 17. This is a typical list, so the list can be very long, and this is important to negotiate, of course. What is a decision where there is a veto? Hiring everyone who earns more than 100,000, for instance, is that normal? Do you have a veto on every change to the articles of association, etc.? This can give a lot of power to the investor if you don't negotiate it properly. Again, every investor will ask for that because they will not accept to put a lot of money and not be protected against main decision, but it's very important to look at the list. So this is a key element of the negotiation. The other key element is, of course, who goes on the board. Most of the investors, they will want to have a board seat because the board seat gives you, of course, this possibility to vote on decision, block decision, use your veto right, also access to information. That's the best place to have information and to decide on the strategy. And typically, if you don't do anything, what will happen? You start your company, you have 3 founders. The 3 founders, they are shareholders, board members, C-levels, so they're everywhere. Then you don't do anything. Maybe you do a pre-seed round and you stay like that, or maybe you have a business angel on the board, and then investors will come and they will say, okay, now we do a board of 5, 2 for the investors, 2 for the founders, and we find an independent that the investors will select. So that's if you do nothing. What I've seen in the past 5 or a bit more in Switzerland is that people start earlier now to start looking for people who can be potentially independent, that are closer to you, and who could stay later. Not that they will not be independent, but at least it's people you've tested, you worked with, etc., and they can stay in this role. And then you will have the investor coming in. And if you have this veto right and you have multiple investors, it's probably good to have 2 investors instead of veto rights. They need the two of them to exercise the veto too, because then you need to convince only one. Same for the veto right of the investors at the shareholders level. The best is that it's not just one investor, but that it's a majority, something like that. So at least you have a bit more power to say to an investor, no, you should follow me on this decision. I think it's a good one, etc. And it's not just you against one investor or versus an investor, and you have a bit of multiple possibilities. Another thing you will have, which is more a practical issue, is information rights, because under Swiss law, by law, you get only the annual accounts, which is way too little for an investor. So the investors, they will ask for a long list of things that you have to provide: quarterly accounts or monthly accounts, reporting, list of shareholders, list of contract, etc. Yes, you have to get that. The question is, try to negotiate something that is reasonable, that you can deliver. I mean, if it's early, maybe monthly account, etc., it's too complicated. Lots of people say, yeah, okay, but it's difficult to provide monthly account, and then it's not like where you were with your co-founders, where I'm late this month. No, if you have an investors, you will make sure you get an email, on the 3rd of the month saying where are these monthly accounts you've promised. So. So as I said, I will come 9 years governance. So I said shareholders agreement, you have the governance, so we discussed that. All these rules, how do you vote, who is on the board, etc. And what I should say is that when you say the investor has a seat on the board, it means you have a contract which says the investor has a seat on the board. You cannot say, I don't want this guy. You cannot say, but we will vote at the general meeting. No, because you have a contract. You're bound by this contract. The shareholders agreement is a contract which is binding for all the shareholders. If you're in breach of this contract, and you can be sued for damages, or there can be protective measures against you if you decide to do otherwise. So when a board in a startup, it's not elected by the general meeting. It's decided in the shareholders agreement, which has 2 founders, 1 independent, and two investors. One investor named by investor A and the other one by investor B. You may have a discussion, of course, with reasonable people in saying maybe you could change because we don't get along with this guy. Can you not put another person from the fund? But you cannot say you don't have your seat. So that's end of the parenthesis. So governance, very often in the shareholders agreement, you will have non-compete for the founders and for maybe the independent board members, because you don't want a founder to leave and start competing, creating a competing business. And as I said before, sometimes you set in stone a general principle that every IP has to go to the company. It's not necessarily always set in the shareholders agreement because it's obvious. As I say, it's more than, when you invest, you will look at that all the IP has already been put there, but going forward, everyone expects that, the IP will be there. So the point here on the slide 8, which this one will go in the investment agreement, is when I invest in the company, I want you to guarantee certain things. Tell me that you've paid the taxes. Tell me that the list of employees with option is actually the one you showed me. Tell me that's all the contracts you showed me, that's the contract you have. So these are what we call representation and warranties. It's a long list where you would say, yes, we have these 3 contracts, they're all valid, we're not in breach of the contract, we've always paid the insurance policies for the insurance, all these things. And what we rule is what happens if this is wrong. So there are 2 ways. Either you say it's the company that gives the reps and warranties. So if it's the case, most of the time what will happen, you said you paid the taxes and we get a bill from the VAT of 250,000. So then you will say the valuation is lower and you will give some shares to the investors to compensate. That's if the company gives. If you give the reps and warranties personally, even though in practice it doesn't happen often, in theory, the investor can go against you and get all your assets and saying you guaranteed that you had paid all the taxes. We have this bill of the VAT. Please put the money yourself in the company back. So early stage investment, very often investors, they ask for this founder's personal guarantee. Later stage, big VCs, now the practice is more, we get just that from the company, that's sufficient. Or we get a small one from the investor, from the founders, just to make sure that the founders, they've really given all the information they have. That it's not so much that the investors, they want to sue you, it's more that they want to make sure that if there is something you know that they should know, you disclose it. So it's used a lot for that. And I'm nearly done. So what you will have, that's more on the term sheet. Of course, in the term sheet, you will discuss about the exclusivity. As I said before, most of the time you will have to give exclusivity to an investor. So, but the importance is to time it. Don't give too long exclusivity and then you're stuck and you have no way out if it doesn't work well. There will be some rules on the fees and expenses. What you need to understand, that's absolutely common. The investors will want that some of the legal fees be paid by the company. But what is important is that you put clearly that this is paid only if the closing happens, not if there is no deal. If there is a deal, and then you have to figure that out in your cash projection, they will tell you legal fees up to whatever, 50,000, 100,000 paid by the company, which means you will of course get the investment, but then you will have to cash out 50,000, 100,000 to pay the lawyers or accountants or other people, advisors of the investors. Totally common, but what is important again, because most of the time investors, they would say you pay anyway, is to pay only if the closing happens. Because then it's not really a risk, it's just you account that in your cost. You will also have some costs of the company, etc. So what are the takeaways? So as I said, you've heard, and it was a lot of jargon, lots of things, but it should give you you should not go into the financing round not understanding all the terms I've mentioned. However you do it, you can ask any ER to AI to help you. You can do it, whatever you do, but you should be familiar with all this concept. Of course, get people to advise you and help you, and so that you understand them. But you have to be familiar, because there will be point where the lawyer will not be with you in the room. The investors, they will push things, and you have to say no. I don't like this liquidation preference. Participating, it's not what we do in Switzerland. That's not the market. It's too aggressive. You need to do that. So you have all this to know, and in addition, you have the challenges that we have a bit in today's world, that it's more difficult to raise money. So you have to do early. It's when you need money, you start early. You have to start the process very early. A lot of seasoned entrepreneurs, they will tell you that they start the fundraising when they just finished one, meaning they already think about the next one, who could be the investors for the next one. Maybe you've met some people who said it's too early for us, too small. Yeah, it's too small now, but they are there for the next one. So you keep the contact with them, because 18 months goes fast if there is 18 months or 24 months between the two financings. And be prepared with the timing, and knowing that at some point you have no cash, and when you have no cash, either you close the company, or you will be in a position where you cannot negotiate anything. That's a terrible position to say we have to accept, etc. And the investors, they know that, and they will see the situation, because they will see in the due diligence where you are. So most of that time they have the information. I'm not saying all of them will use that, but some they'll take into account. At the end they'll say, now we don't move on any point. They have no room to negotiate anymore, because they don't have money. So try to avoid this situation. Again, it happens to all startups, but try to avoid. And that's why you need to manage the cash and have a bit of plan B and saying, yeah, if we short of cash, we know that we have this business angel who can put 100K. He can do a convertible. And then you give it something that, often this convertible, they convert into shares at a discount. So there is a slight interest, and someone may say there is not so much risk. You're already negotiating, so you put that in place. Or you put the convertible before signing the term sheet, but saying we can call the money when we need it. So if we don't need the money, we don't take the money. If we need the money, we can ask the lender to put the money. And as I said, I think it's fighting on everything doesn't make sense. So depending on where you are, where you see the future, you should focus and choose your battles. And you may see that valuation, there is no battle on valuation. So fight on some of the other terms. Say with some of the other terms, they need to stop after a certain point in time. We need to put threshold. We don't let the investors decide everything. You can find other places to negotiate. And on that, because I see that the time is running, I hope I've enlightened you a bit about things. And if you're afraid or if you think it's all very complicated, I think it's good, because that's what you should think. That's what you should think. Everything is manageable. Plenty have done that before you. There are plenty of good advisors in the market. Again, select people who have done that. It's a different world. So don't go to the lawyer friend who has never worked with startup. Don't go to someone who has never done a financing round. Don't ask a guy who does only. It's not that it's super complicated. That's not what I'm saying. It's just that it's a different world, and you need to know it and to know how investors behave, to know where you can push, where you cannot push, to have this feeling. And that's what I like as a lawyer, because when we advise startups, and I advise also other companies, large companies, big corporates, investment banks, etc. But when I advise a startup, is that we can give more than just legal stuff. We can also advise: should I push the valuation higher? Yes, no. As I said, it's not always the answer. It's not always yes. Should I take more money now? What do we do? Do we delay a bit? Do we sign this term sheet rather than this one? I like this one. I had the question recently: 3 term sheets. The one I prefer is this one. Yes, but the terms were the worst. So the feeling was good, but there is a point where the difference was so big, there was no question. You should try to push them. They say no. If it's like that, at some point you say, yeah, let's go maybe with someone I don't have the same contact with, but it's clearly a better deal. So and all these things, I mean, you need people to help you. So people who know the market can help you. Questions?